Hey, this is Kevin Gormley, a CPA that does financial planning, and today I wanted to talk about what's going on with the market, and I'm using some Morningstar slides. The first thing I wanted to talk about is our nature to be short-term focused, although, and Morningstar here says inappropriately focusing on short-term risk versus long-term risk. And by the way, we all have this issue. I don't care if you're 40 years old or you're 80 years old. The things that happen in the short term, such as the volatility we're feeling now, can affect all of us. People that have the nature to not even pay attention are usually the best investors, but they're not always the people that are investing and saving. So many investors talk long term, but they act short term, and I'll show you some data in a moment that actually proves this. If we have a 15-year time horizon, we should not really be acting in the short term, but we do. We're overly sensitive to interim volatility regardless of the time horizon. If you are not near retirement and you are worried about your retirement funds after the 10% correction, you are absolutely normal and absolutely human. But that is something that is really not helpful for investors. And then, again, we may actually behave as if our time horizon is a lot shorter than it truly is. And so I'm going to pause and go to the next. So this slide is a little busy. Let me just acclimate you to the slide here. So this line right here is the amount of money that's either coming into equities here in the cash flow. I guess this is like a blue color. If it's below the line, that means money is actually leaving equity funds, mutual funds, any type of funds. And so we can see here 2003, 4, 5, 6, nearly to 2007, it was very, very stable of the amount of money going into equity funds and out of equity funds. The market during this time, 2005, 6, and 7, this is the growth of the market. They're showing $10,000, but this $10,000 went all the way up to nearly $42,000 during this time period. So what happened to inflows of equities? So again, if we're on this side of the line, that means more people are buying into equity funds than selling their equity funds. And so there's inflows of money. And so we see huge spikes of money going into equities, huge spikes every single quarter. And what ends up happening is the market starts to correct, and people continue to say, let's buy the dips. But what ends up happening is the major correction comes here in 2009, and when the major correction happens, everyone starts to capitulate. That's the word for just give up. And then you see how many quarters that people are actually pulling more money out of equity funds than putting it into it. And I like this slide because it ends in 2012, before the big run-up in 2013. And what happens in 2013 is we have a 32% spike in equities, and then all of a sudden 13, 14, end of 13, 14, and 15, we've seen inflows back into equity funds. So if you don't believe that we all are our own worst enemies, this should really prove to you that, again, people are taking money out when the market's gone back down. People are buying nearly at the market high. This happens over and over again. And if this is a correction, like the first part of this, or if this is a major downturn, again, if you have a good amount of time, there's really no reason to act. The final slide I'm going to show you is the slide, it's called the Ibbotson chart, and again, this is from Morningstar, and this goes before the Great Depression all the way through I think it's June of 2013. And so what do you see with equities? The small cap equities have actually outperformed larger companies. The largest companies have done extremely well. And this is a logarithmic chart. I think that's what you call it. And so $1 invested in 1925 becomes $4,000 in June of 2013. Now, no one's going to have that time frame, but it's just interesting to see those large numbers. The small cap actually $21,000. Government bonds had a return annualized of 5.6. Now, we've had a tremendous bull market recently in government bonds. And then finally, Treasury bills have barely outpaced inflation. And so during this time period, people that invested in the bank or Treasury bills or any type of really safe assets, they felt like they were making money, and they were making money, but their purchasing power because of this inflation didn't increase at all. So really, if you want to invest, you really need to go up the risk scales. And then so the final thing I'll mention to you is that this little area right here, in I guess it was about 1999, 1998, this little correction right here, this could have been a 20% correction. If you watched any of the TV stations, there was probably something massively alarming going on. Here too, there's probably something massively alarming in 1988 or 1989. Massively alarming. We didn't have the news media that we have today when we have these. We had to wait at least a quarter for our statements. Today, after 2008, 2009, this was a big correction. But even if you invested at the height of 2007, when you add dividends in, you still made money through 2013. So my final point, and again, this is easier said than done, but my final point is when you see a move like today, 400 points down in the Dow, and all the people are screaming on TV, and maybe even your coworkers are saying, this time is different. This could be really bad. I would just remind you that it may just be a blip on the chart. You know, past performance does not indicate future results, but all these times we might have thought it was, this time is different, and including 2008, which to me truly felt different. So thanks so much for listening and watching. If you have concerns, let's talk. Again, it's very human to feel concerned, and people on TV, on the webs, there's lots of doom and gloom, and we need to make sure that we have a perspective, and hopefully I brought that tonight. So thank you.